Hello and welcome back to Principles of Macroeconomics. I am still your host, Dr. B. Very happy to have almost all of you with us today. As we start the second week of our journey looking at Principles of Macroeconomics, so of course the first thing I want to do is find out what your thoughts were about the first week. How did we all do? How do you feel like you did? Did you have any concerns about the first week, or how y'all feeling? You got that first week out of the way. So tell me, you know, how do you all think it went? How did that first week go? Feel free to unmute your mic and tell me how it went,
I
Maria.
think, I think you went very well for me.
Good. That's great.
Yeah.
That's good to hear.
Yeah, I think the first week is like the easiest one.
Well, yeah, maybe. Hopefully it stays easy, right?
Yeah.
Yeah, great. Thanks, Maria. Thanks for sharing. Judith, please.
Yeah, it was okay for me. Discussions were really good. So yeah.
Hey, good. I like that. That's good to hear.
Mhm.
Thank you for sharing. I do appreciate that. It means a lot to me to know how everyone's doing, especially after that first week. Thank you for sharing. I appreciate it. Okay, let's jump into it. Let's talk about the second week, and we'll jump into chapter 2, and then if we have time, we'll jump into chapter 3. So here we are in the classroom. Most of you were able to get that first week completed on time, so thank you for that. That means a lot to me. Um, you know, as I know that you're all busy, you have your family lives, you have your work, you have your other classes and things like that. So I really do appreciate when you do things on time. It's good for you. It's good for me. And it makes the course run a lot smoother. So again, thank you for completing your work for week 1 on time. That you had that discussion, and you had the chapter 1 quiz. So again, thank you. I really do appreciate it. So looking forward to week 2, which is what we're about to jump into. We're going to have chapter 2, and we're going to have chapter 3. So the cool thing is, and this is a little different, it's called a hypothesis assignment. And so what this is, and this is also due on Sunday night, it's called a hypothesis assignment. And the way it works is you'll open up the assignment. It'll open up, it should have opened up a document. I'm surprised that it didn't. So I'll double check that. There should be a document in there, and if there's not, it's okay. I'll fix it. Yeah, there should be a document called Economic Growth and Neutrality. And so the way annotations work is you'll log it when you log into the classroom. You'll open up that assignment. You'll read through the article, and then you'll post what we call an annotation. So you'll have to do 2 annotations and 2 replies. An annotation is real simply like one of these things here at the bottom. You're summarizing an idea or a concept, comparing and contrasting, something along those lines. Or you could even post. You could ask questions, and so the way it works is you'll simply highlight an area in the text, and then you'll create a note, basically. That's what an annotation is. It's very short, very easy, and so you'll create 2 original annotations, and you'll respond to 2 of your classmates, and so 4 entries total. But we'll make it fun, I promise. So before you start the annotation, kind of read through these, watch this short video, read through these instructions, and then jump into it. It'll be right here under Engage and Explore for week 2. And then, of course, we'll have the Chapter 2 quiz and the Chapter 3 quiz. Just as before, they're relatively short in nature. I think they're like maybe 10 questions each, thereabouts. I think they're almost all multiple choice. There might be a couple of true, false, or whatever. And you have 2 attempts, so that's a great thing, right? It's like I try to help you to the best of my abilities to learn this stuff. I know it's not easy that first time around, so that's why I have the 2 attempts there for you. So without further ado, let's go ahead and jump into chapter 2. Thinking like an economist is the name of this chapter, and the reason why we call it thinking like an economist is really because it's important to understand. I don't know why it always does this. It's important to understand how economists think, because the economists have like a certain way of doing things, and they have a certain way of thinking about things, and so that's why it's called Think Like an Economist. So let me try to get this thing out of my there. Thanks. Okay, so economics, it's a science. People think of it somewhat of an art form as well, but it really is a science. There are a lot of mathematical equations that go into economics. There are a lot of theories, a lot of ideas that govern economics. We think of things like the interest rates. The Fed has been raising interest rates over the past couple of years in order to help to control inflation. The interest rates are a tool that they utilize, and there's a lot of science that goes behind that tool. The science is, the mathematical equations that help to determine what interest rates. There are a lot of data collection involved and analysis, and that's why, and there's a scientific method behind economics, and so when you think of economics, it's a science in itself, and that's why the degree that you're going after, it's really a science degree, yeah, and the things that we learn in your courses, and especially in this one, it is a science, and that's why the degree you're after is associates in applied science, right? So in thinking about economics being a science, we use a scientific method to understand economics. And a part of that has to do with understanding that there's a disproportionate development and testing method and theories about how the world works. Economists think about how the world works as a whole. So if you think about different countries engaged in trade activities with each other, or how individual consumers make purchasing decisions, or groups of individuals making decisions about their consumption behavior, etc. Economics looks at these different theories. Economists look at these different theories, and they try to understand how the world works and why it works the way that it does. And we do that through observation, theory development, and then more observation. Because remember, economics, the definition of it is it's the study of the economy, right? And so that's why it's a scientific approach to thinking like an economist. Economists oftentimes conduct experiments within economics because it's a very practical approach. Economists pay very close attention to the natural experiments that are offered by history. What we mean here is that as we learn new things in economics, we oftentimes look to what happened in the past, and that helps to inform what might happen in the future. There are, in science, and anytime we look at science, there are assumptions that need to be examined as we create theories. And as we study economics, we include assumptions when we make decisions. So assumptions can simplify a complex world to make it easy to understand why things happen in economics. Example, making a decision on whether to consume one type of food over another, it sounds like an easy decision, and it is, but it can be very complex when we look at it from an economic perspective. The economic perspective takes into consideration things like the opportunity cost, short-term and long-run effects. It's like, why would you think like that, right? So we assume things to make decisions like consuming one type of food over another. The assumptions help to simplify that type of thing, especially when you look at it from a broader perspective. So it's important that as you make decisions and you think scientifically, you think about all of the assumptions that go into making that decision. It's important that we look at assumptions to help us to answer questions, but also to understand short-term and long-term effects. Economists oftentimes develop economic models to understand in a very simplistic way the behaviors, the assumptions, and the conditions within an economy. These economic models are typically equations and diagrams, like graphs and charts and all of those kinds of things to help us to visualize what's happening in the economy. The equations and diagrams oftentimes omit detail, meaning we leave certain things out for a reason. An example of this. When or let's say the country is making a decision on raising interest rates, some things that they might leave out of that decision process is what will the thought be of the society? Okay. Will they not like the government? Will they like the government? They'll omit those details. That's not a part of their decision making. The decision is, do we raise interest rates or not? So we leave out certain details as we make those kinds of decisions as a country. We look at things like the unemployment rate. We look at the participation rate. We look at other socioeconomic factors before making a decision to raise interest rates, but we also look at how high the inflation is. So, and we take other factors out of consideration. So that's what we mean by omitting details in developing an economic model. It allows us to see what's important. We build the model with the assumptions in mind, and we try to make it very simple to understand. A couple of these models oftentimes involve the use of what we call a circular flow diagram. This is a visual representation of an economy that takes they're basically two circles together, right? And then in the middle is what we call a cross section that involves both circles of data. That's what a circular flow diagram is. And it shows us how the dollars flow through different markets among households and firms. A firm is a company, as you know, and a household is your house, okay? And so the circular flow diagram shows how money flows from the company that you work at to your house and what you spend that money on. Okay, that's what a circular flow diagram shows us. It shows us the physical flow of the cash. It also shows us how companies and households make decisions. And oftentimes those decisions are based off of two different markets. The market for goods and services and the markets for production. The next few things I'm going to show you have to do with the idea that individuals work for a company, the company pays them. The individuals purchase goods and services. Those goods and services need to be made somewhere, usually in a factory. Those factories have inputs and outputs. The inputs are labor and cash. In order to produce goods, right? Those direct materials, direct labor, and factory overhead. Those are the things that go into manufacturing a good that the households then purchase. See, it's cyclical. That's why we call it a circular flow diagram. I'm going to show you what it looks like here in the next few slides, but I just want to kind of get that into your mind, because if you think of it from a manufacturing perspective, it makes it easier to understand. So the companies, the factories, produce the goods, and the other companies produce the services. Factors of production are raw materials, direct labor, the people that live in the houses, that work at the factories, and some factory overhead. Factory overhead usually involves a lot of cash that the business puts in for operations. Those are the inputs. The outputs are finished products the household buys. The outputs also include wages that are paid to the employees that live in the households. And a couple of other things, mostly investing activities, taxes, etc. That's the firms. The households, these are where the people live, work in the factories that produce the goods. Households also consume those same goods and services. So this slide kind of summarizes that aspect. The companies produce the goods and services, and they use labor, raw materials, and cash to produce those things. And the households are the ones buying from the firms, consuming those goods and services. And the exchange happens back and forth. The people who live in the houses work at those firms. The goods that the firms build are going to the households. That's what creates an economy. So the firms and households, they interact with the markets. The markets are where companies are selling and the people that live in the houses are buying from. A market, as we talked about last week, a market can be defined as a store, can be defined as a lot of stores, can be defined as an area, geographic area. Market is where the households go to purchase goods and services from. The companies or the firms, they're selling them. So that's how we look at a market in this perspective. The markets for the factors of production, this part's important. The companies are purchasing the labor from the households. In other words, the people that live in the houses work at the company, the firm. The firm pays wages to the households. That's why you see households are the sellers, meaning they're selling the labor. The firms are buying the labor. That's what that means. So it sounds weird, but here it is. This is the image I wanted to show you. And this is probably the best way to understand how an economy works. So there's two flows, right? There's a green flow and a red flow. And you see they move in opposite directions. The green flow shows the flow of the dollars, and the red flow shows all the inputs and outputs. First, let's talk about the green flow, the flow of money. The flow of money, as we can see, starts with, it starts with spending. Okay, the households are spending their money that they earned from working, spending that on goods and services. The markets who are collecting money from the households for the sale of the goods and services, they use that revenue that they've earned to then produce more goods and services and to hire employees. The firms then use that revenue as an output in the form of wages, rent, profit, taxes, etc. And that is paid to the employees. Employees who live in the households then use that where they work, it's income to them. And then it goes back around, you see? So that's the physical flow of the dollars. Let's look at the inner circular flow, the red line, to understand the flow of inputs and outputs. So let's start with the markets for goods and services. The markets sell the goods and services to the households. The households buy the goods and services from the markets, and the households utilize their labor, the people that work in those houses, their land, and their money to produce goods and services. Markets for factors of production. So the households, they're spending money to drive to work. They're working. They're paying taxes on the land. The markets for the factors of production where they work, they're producing goods and services that the firm then sells the marketplace. And that goes around and around and around. And it doesn't stop. And that is, in essence, and this slide really sums it up, this is an economy. It shows it in a circular flow. You see the relationship between where people work, produce goods and services, and households where the people live that consume those goods and services. That goods and services flow through markets. So this helps to put it in perspective. Are there any questions on this so far? Or are we doing okay? The part's a little complex, right? So that I just want to stop here real quickly. Any questions at all? We're doing all right.
Good so far.
Awesome. Thank you so much. Appreciate it. Okay. So now that we have an understanding of the physical flow of the money and the flow of goods and services, it's important to now understand what we call the production possibilities frontier. The production possibilities frontier help both the households and the companies to understand their ability to produce a maximum level of output. That's why we call it production possibilities frontier. This is a graph that shows us the combinations of the outputs that the economy can produce, the goods and the services. It also shows us the factors of production and the production technology. From the earlier slide I showed you here, the factors of production include the things like the companies who are manufacturing the goods and services and the labor that goes into that. Those are the factors of production. Factors of production go to the firms, then goes to the markets, and then back to the households, so forth and so on. So this graph, a production possibilities frontier, shows us those factors of production being leveraged at their maximum output. And we also look at things like production technology. Production technology is the use of technology that aids in the production process. So here we have the production possibilities frontier. This is what it looks like. And it shows us the combinations of those outputs that we talked about earlier, which are the production of goods and services. It shows us the maximum levels of production. So let's take a look at this. This example that we're looking at is the production of cars and computers. Okay, two different products, two very different products, cars and computers. Really, we could look at the production possibilities frontier for all products, but just to keep it simple, we'll look at two different products, cars and computers. This data shows us the points of production based off of the quantity for each type of product. On the x-axis, and the one that on the bottom here, shows us the number of cars being produced from 0 to 1,000. The y-axis, up and down, shows us the quantity of computers being produced from 0 to 3,000. The points on the graph represent the possibilities of producing both computers and cars based off of the levels of production. Okay? So here we can see the graph. Points A, B, and D intersect. Point A intersects with making 2,200 computers and 600 cars. That's the most we can produce of those two products together. Yeah. Point B represents 2,000 computers and 700 cars. I can only produce 2,000 computers if I produce 700 cars. Okay, you see the difference between point A and B of 200 computers and 100 additional cars. The reason why that is because it's the most that I can produce. I can only produce 2,000 computers if I only produce 700 cars. I can only produce 2,200 computers if I produce 600 cars. It's the frontier, it's the maximum, yeah? And it's what the possibilities production show us. Point D, if I produce 1,000 computers, I can produce 300 cars. But that's not the optimal point. I can produce more than that. Point F shows me I can produce almost 3,000 computers, but I can only produce about 100 cars. So that's not really optimal, right? I want to be able to produce more cars and as many computers as I can produce. So we follow that line on this graph to find the best possibility for production along the frontier line. Yeah, it basically shows us the optimal point of production is what I'm trying to say. So we find on that line the efficient levels of production. The economy gets all it can from scarce resources. We talked about last week the scarcity of resources. The scarcity of resources tells us that there's only a finite amount of things like land, labor, goods and services, housing. There's only so much available, right? Scarce. Understanding that we can produce as much as possible makes it efficient. Those points that I just showed you in that graph, along this production possibilities frontier line here, points F, A, B, and E are optimal. Which one is the best one? Is it A or is it B? Depends on who you ask. I like B the best because it seems like that would be the most efficient. And if we think about that from that perspective, the points on the production possibilities frontier line are the most efficient. Of course, there's a trade-off, right? I can only produce so much of one of those two products. I need to find the optimal point. Moving between point A and point B, I move from point B to point A, I give up 100 cars. If I move from point A to point B, I give up 200 computers. So it's a trade-off, right? I have to produce less of one product in order to produce more of the other. But which one is best? I don't know. Oftentimes when we think of that, in business, when we make that kind of decision, it's usually based off of which one can I get the most profit out of. Right? And that usually dictates which product out of two is going to get produced more. The inefficient points of production are the ones inside the production possibilities frontier. So going back to our graph here, and you probably heard me say it earlier, point D, 1,000 computers and 300 cars. That's not a whole lot. I can do more than that. So point D is inefficient, very inefficient. I want to maximize the amount that I can produce. Point D does not do that. Okay? So point D on this graph is what we would consider to be inefficient. There's an opportunity cost involved here of producing one good. The opportunity cost, of course, is the cost of producing the other good. Remember, and we talked about this last week, an opportunity cost is the cost of what it is that you gave up in order to do one thing or the other. So the opportunity cost of producing one good is the cost of the other good that have been incurred. So the slope of the production possibilities frontier represents that opportunity cost. The opportunity cost also can be shown in between points A and B. Opportunity cost is I could have produced 100 more cars or 200 more computers. Can't have it both ways. It's got to be one or the other, point A or point B. So the opportunity cost is that difference in the quantity that you gave up to produce the other good. You see? The production possibilities frontier that we just showed you is bowed outward. It slopes it's like a half moon shape, right? This kind of, it's bowed outward. That's what that line, the blue line, shows us, right? It's bowed outward for a reason, because it shows us those differences in opportunity cost. And it also shows us where we're maximizing our levels of production. So the opportunity cost of the car, of course, is going to be the highest, especially when the economy is producing a lot of cars and less computers. When the opportunity of the car is lower, that means we're producing a lot of computers and not a lot of cars. Remember, opportunity cost is the thing that you gave up. So if you're going to produce more cars, opportunity cost is going to be very high for computers. The opposite, of course, is also true. So that's why these production possibilities frontier graphs are so useful, because it shows us the points where we could be the most optimal in production. Now, of course, as technology improves, it helps in the manufacturing process, right? Because now I think about the way that automobile manufacturing works. There's a lot of machines, a lot of robots that are working alongside their human partners in order to manufacture vehicles, right? And so that's a technological advancement. Those type of technological advancements push that production possibilities frontier line, it pushes it outward. I can produce more. I have technology helping in the manufacturing process. Technological advancements also help to further economic growth. Because I'm producing more, that means I'm selling more. That's a way of growing the economy. Right? And I can produce more of both computers and cars, because I'm using machinery, robots, automated machinery to help me in the manufacturing process. That means I can use my human labor in other areas. And it produces more goods, right? So here we have, going back to our example, computers and cars. Now that I have computer automation, robotic automation to assist in the manufacturing of computers and cars, less human capital, more automation, that automation helps me to produce more. So it pushes the possibility frontier graph out. Now I can produce 4,000 computers, whereas before I used automation, I couldn't do it. I could produce 1,000 cars. I could produce a maximum now, point G, 2,300 computers and 650 cars. You see, I've gone up on the production for both products. That's what technology does. It helps us to improve our capabilities and maximize our outputs. So that's the production possibilities frontier. Any questions on production possibilities frontier? Is it pretty clear? Does it make sense? Are there any questions at all so far? We're still doing okay. Hopefully I didn't put you all to sleep with stuff. Are we doing okay?
All good.
Awesome. Thank you so much. I appreciate it. Okay, so this class is macroeconomics. In macroeconomics, which is this class, thank you, is we look at the economy-wide phenomena of things like inflation, unemployment, and economic growth. We look at economics in this class from a national perspective. We look at the whole country. In fact, we even look at the whole world. It's macro, meaning the bigger picture. That's where the macro comes from. Microeconomics, which is Accounting 202, that course looks at the study of individuals, households, and companies, how they interact in markets. It's micro. It's a smaller picture. So the smaller picture lives within the bigger picture. Think of it like a puzzle, right? You got a complete puzzle. That's macroeconomics. You got a puzzle piece. That's microeconomics. Word micro. Looking at something from a microscopic perspective. So that's the difference between macro and micro. This is a course on macro, so we're going to be looking a lot at the whole country. It's like inflation, unemployment, and economic growth. In economics, we look at a lot of statistics, right? We look at descriptive statistics and prescriptive statistics. Descriptive statistics, we look at things like the positive statements. This attempts to describe the world as it is. We use descriptive statistics to describe things. Right? Descriptive statistics, and I know we talked very briefly about this last week. We're looking at it from the perspective of current and past. We confirm or refute by looking at the evidence, what happened in the past, to help us to inform the future. Look at things like minimum wage laws and unemployment laws. Prescriptive statistics is more forward-thinking, more forward-looking. We attempt to prescribe to understand what the issues are. The prescription helps us to solve those problems. Example, the government should raise the minimum wage. That's the prescription. That's what the government should do. They do it or not, that's another story. But prescriptive statistics tells us what should be done to solve a problem. Of course, here in Washington, D.C., which is where we are, we have at our footstep the entire economic powerhouse of this country. The Council for Economic Advisors, they talk to the president about the economic situation here in the United States. There's an annual economic report. The president comes and talks to Congress, and Congress talks to the president, and then, of course, the president delivers a speech to the American public about how the economy is doing. That's how economics in Washington, D.C. works from a political perspective. Of course, who's here? We have all the big players here in D.C. Okay, we got the Office of Management and Budget, also known as OMB. We have the Department of the Treasury, and that's our not so fun friends at the IRS. Yeah. Department of Labor, right? Department of Justice, Congressional Budget Office, or CBO, and of course the Federal Reserve. We got all the big players here in D.C. All these big players, they don't always get along and they don't always make the best decisions, but they're here. Economists oftentimes act as advisors, and they try to prescribe the best policy forward. They talk as advisors. Economists try to explain things in very simple terms to the public. Because the public, they don't study economics. They're not all economists. They don't understand things like interest rates or, how interest rates are used to combat inflation. They don't think about things like that. So economists try to speak in simple terms that help people understand what's going on. Economists are oftentimes press advisors. You'll see them on the news a lot and talking about economic things, right? They oftentimes also act as legislative affairs advisors to help Congress to propose new laws and look at things from a critical lens. Economists also are political advisors, and they help to affect election outcomes. And of course, the economists also assist the president in decision making. A lot of times they argue with each other about what's right, what's wrong, based off of theory. Right? They don't always think all the same. Oftentimes they're not even on the same page. Economists have competing theories. There's different normative views about policy changes that should be accomplished. There's always going to be a difference of opinion in economics. That's normal. It's normal to think one way and another economist thinks another about the same thing. Totally normal to have competing views and competing values. When there are differences, it's important that the economists think like scientists that they are. And they validate different theories. They also use things like statistics to govern how those theories are being measured and validated by using things like economic variables, the relationship between those variables. From an example, a difference in values. Here we have two individuals, Jack and Jill. I believe they went up a hill to get a pail of water, from what I hear. They have the same amount of water from a well, but there's a difference, of course, in the overall value of that water. Here we have Jill's income. She's earning $150,000 a year. Her taxable rate is 10%. She pays $15,000 a year in taxes. Jack, tax income is $40,000. Taxable income is 15%. Pay $6,000 in taxes. Does it seem fair to you? It doesn't to me. They both have the same job. Okay. Look at the tax rates. Why is it that the person in the lower income is taxed higher? These are things that economists disagree on. These types of policies. Other life barriers. Rent control. This is very common in New York City and in other large cities around the world. Rent control dictates the ceiling prices of rent, okay? And that rent can only go up by a certain percentage every year. In New York City, it's around 7%. It's like the maximum that your rent can go up every year. It's a form of policy control in order to restrict the cost of housing from rising sharply. Okay. It's a good thing for people in society that don't make a whole lot of money. Okay. It's not so good if you're the landowner, because oftentimes the rent does not always cover all the costs. So there's debate over that policy. Trade barriers. Trade barriers are a form of tariffs and quotas. Tariff is a form of a tax that we put on goods coming into the country from other countries. Import quotas is a restriction on the number of imports of a specific product from another country. Examples of this would include like vehicles, cars that are made in other countries. It could have been made here. If, for example, Nissan, we'll say, a car manufacturer in Japan, they're only allowed to import a certain number of cars every year. The reason for that is to encourage manufacturing here in the United States, which produces more jobs, produces more revenue for the country. Yeah. So there's a difference of opinion, and economists typically don't like tariffs and import quotas because it puts barriers on trade. And this graph shows it, right? Economists don't all think the same. Yeah, there's going to be ones that agree, disagree, and ones that don't have an opinion or don't know. We're not going to roll through that example. I want to show you this graph. This graph shows us trends in the United States. Take a look. It's the same information, it's just broken out different ways. Let's take a look at compensation of employees in the pie chart. 62%. That is a huge expense for companies. The largest expense for any company is labor. Labor is always the most expensive thing, typically. Because, and for those of you who are studying HR or interested in becoming HR professionals, or maybe you already are, labor not just wages. It includes all the benefits, right? That's why it's usually greater than half of the company's overall expense. Companies also, of course, pay out things like research and development, rent, interest, taxes, etc. And then they have a little bit of profit. This is a very common pie chart for a company. Let's take a look at the bar graph in the middle. This is income from 2017. Today, it's probably closer to 70,000, I think, is about the average. And that's, of course, a result of inflation, etc. That's probably true for all of those countries. The wages have increased over time. And then we look at it from the time series perspective in chart C here. And we can see the rise in the productivity over time. A lot of that has to do with the additional automation from machinery. People who study economics love their graphs. And we look at different variables and we graph them using scatter plots. So I want to show you what one of those scatter plots looks like. This is a scatter plot. We can see in this graph the grade point average of a student from half all the way up to 4%, 4.0, right? Perfect score. And then the amount of time that a student would study each week. There is, of course, a direct correlation, right? You can see that the amount of time used each week to study, the higher the grade point average is. And that's pretty typical. That's about an average student, I would say. And it's true. The more that you study, the higher your GPA will likely be. So we have a couple of data points. This is the same person, okay? So same person, got a 2.0 grade average, studied 5 hours a week. Not very good. Same person, studied 25 hours a week, and has a GPA of 3.5. That's great. There's a couple of outliers, right? The more time studied, almost a 4.0. Here's another outlier, 5 hours, almost a 3.0. That's unusual. Of course, it goes up and goes down. You can see the correlation, right? The relationship. We also look at data and demand curves. So the data that's our inputs. Okay, we look at things like prices and wages. And we also look at goods and services. The goods and services, that's on the demand curve. The demand curve shows us the effect of the price of goods based off of the quantity demanded, based off of individual incomes. So here we have some data. We can see the prices on the y-axis. We got $10, $9, 8, 7, 6, 5. And based off of income brackets, we can see the demand for novels, books. $10 a book, not a whole lot of people want to pay that much. If you make $30,000 a year, you might buy 2. If that price were $5, you'd buy 22. If you make $40,000 a year, at $10 a book, you might buy 5. But if that price were to be $5 a book, you might buy 25. If you made $50,000 a year, $10 a book, you might buy 8. If the price were $5, you would buy 28. The relationship here is that the lower the price point, the more of something you're likely to buy. If the price goes up, you'll probably buy less of it. That's the point we're trying to drive home. If it's a negatively related variable, there's variables move in opposite directions. If they're positively related, they go in the same direction. Yep. We have a demand curve of those books that we showed you earlier. But I'll buy 5 books at $10 a piece. But if the price drops down to $5, I'll buy 25 of them. We can see that as the price goes down, the quantity goes up. The quantity demanded goes up. And that can be said for all 3 income brackets. Understanding the slope of the demand curve, so here's the formula that we would use. The slope is the change in the y variable divided by the change in the x variable. This delta sign represents change, right? To find change, we simply take the new point minus the old point. So new minus old gives us the change. Yep. This kind of describes the slope of the line in terms of the differences here. So if it's upward sloping and to the right, it represents a small positive number. If it's an upward sloping line that's steep, steep increase, it's a large positive number. If it's downward sloping, then it's a negative number. A horizontal line is 0, and a vertical line is infinite. So here we have a downward sloping to the right, and we find the slope. The way we do that is we look at the difference between 2 data points. Here we have $8 per book down to 6. That's a drop of 2. 6 minus 8, that's 2. And then, of course, we can look at it from the quantity change. 21 minus 13 is 8. So the slope would be minus 2 divided by 8. And that would be the slope of the line, which is negative 1/4. The relationship, of course, between quantity demand and the price. As the price goes down, the demand goes up. Price goes up, demand goes down. That's cause and effect. If we omit a variable, we can see the correlation, right? Cause and effect. Here's more cause and effect. Okay, so thinking like an economist. That was our chapter on thinking like an economist. Any questions so far? We're doing okay. All still awake? Yes, no, maybe?
Yes, we're still here.
Yeah, we're here.
Okay.
Yes,
All
we
right.
are.
Yes, still here.
I know it's real entertaining stuff, okay? It's real exciting. Said no one ever, but it's important to kind of get into like that scientific mindset when we talk about economics, So that's why this chapter is somewhat important. So I'm going to stop this part of the recording, and then we'll take care of chapter 3 pretty quickly. It's a very short chapter, so we'll just cover that today. So that way y'all can use class time on Wednesday to do your work. Yeah, I think that sounds like a good arrangement to me. So let me go ahead and stop this part, and we'll start the next part. Please stand by.